We're at the end of day 2 of the PSG annual conference, coming to you from Sun City. I'm joined now by Anet Ahern, Chief Executive of PSG Asset Management. Thank you for joining us. PSG and PSG Asset Management has seen incredible growth. What is the kind of secret to your success, and talk me through some of the recent highlights?
I'm glad you used the word secret, because when I joined PSG Asset Management a few years ago, one of the things that struck me during my interviews is that this is really a well-kept secret, and it shouldn't be. So one of the first things we did is that our name, even though PSG is very well known, and PSG Wealth was very well known, PSG Asset Management really wasn't. So we spent quite a bit of time making sure that we're in print and that advisors outside the PSG group know about us. We established a retail sales team who've been doing a great job. Of course, none of that would have mattered if our investment team didn't continue doing the right thing. So we had a lot of things on our side. And then over the last year, we had a couple of really big milestones, and that was to be accepted on some of the big investment platforms. And that is a combination of performance and awareness. So to get on the platforms, it's a bit like getting into a big supermarket. People have to ask for your product, and the supermarket has to know that your product's going to sell, because otherwise they don't want to waste shelf space on it. Pretty much the same. Those were very, very big milestones for us. And I think we have seen great growth, but we are still very small in relation to some of the bigger players. So we've still got a lot of potential.
Speaking of potential, we've had 5 years now of a running bull market. There's been a lot of talk today around how much longer can it keep going, predicted volatility. What are your thoughts around that?
I think that there are some very overpriced shares in our South African market, and they are some of the bigger shares. And what happens is that they've dominated the move in the indices. So we're less concerned about what the indices do, and we're more concerned about, can we find enough stocks to fill the basket that's that portfolio? Can we find enough stocks, and what do we mix them with? Do we mix them with bonds, property, or cash? Do we have enough offshore? So we are less concerned about the market. We have been concerned about some of the big stocks for some time. So you would find the likes of a Naspers, SAB, we don't have any at all. We haven't had any for a long time. So we've instead elected to buy shares that are listed overseas, or some of these smaller or mid-sized, more interesting opportunities, or some of the neglected opportunities like the resources. So from that point of view, I certainly think in some of those shares, they are priced for perfection. They're priced for incredibly high expectation. And it's one of those strange phenomena where people talk about it for a long time, like the tech stocks. We knew they were expensive for a long time, and then it happens. We don't know when that's going to happen. So what do we do in our portfolios to counteract that? Is we buy shares that we are sure we understand, that we think are cheap enough. And a share can be a little bit expensive if it's a really good quality stock. So we mix those two variables. We look at the quality of the company, the management. We look at what the valuation is. And we fill our portfolios with only those type of stocks. We don't buy something because it's in the index. We don't buy something because it's big and everybody else has got it. Then what we do is we are at the moment finding tremendous value in cash, because what cash does for you in a portfolio, even in a flexible portfolio or a balanced portfolio, is it gives you the opportunity that when something does happen in the market that you can't predict, you can take advantage. So we've got a very high cash weighting in our portfolio. We've got some lovely sort of long-dated cash instruments, etc., but essentially it's still cash. So and we can find real yields in cash as well. So we are waiting for the time that some of those high-quality companies that are overpriced now are becoming cheaper, or some of the companies we like are becoming ever cheaper, and we are going to, as my team loves to call it, pounce.
Fantastic. So, I mean, where does one even, for advisors, where do they kind of start looking for opportunity? What are the sectors you think that kind of do provide some value and opportunity? A lot of the things that, as you were saying, a lot of the things which are sort of would often be considered low risk because of the way they're priced at the moment, or almost high risk. So what would you suggest there?
What I would suggest to an advisor, I mean, we happen to, at the moment, find some value in some of the resource stocks, but not all of them. So it's not really a sector call. So what I would suggest for an advisor is I really think the solutions that are made up of various asset classes and sometimes various managers, and we're a happy part of those type of solutions for quite a few multi-managers. I think those really play quite an important role, because one of the speakers today made the point that within those solutions, the underlying manager is able to make the changes more quickly, in some cases more early, because you need to convince a client to make those changes. By the time the client sometimes you get their buy-in, it's almost too late. So that can happen, and it can happen in a very tax efficient way. So I actually think that for me, the advisor's role is not, and this is my opinion, it's not to scratch around for opportunities in the market like a real bottom-down fund manager does. I think some of them have discretionary portfolios with their clients, but the bulk of them should be focusing on understanding the time horizon, risk, and total picture of the client so that they put them in the right solution, where you almost have this calm exterior, but underneath there's a lot of positioning going on with the underlying managers. So for me, I would say that is possibly the best way to deal with the volatility, the uncertainty, and the tremendous dislocation we have in valuations, for instance, between the expensive industrials and the cheap resources, between bonds and offshore bonds. That to me would be the best way to deal with it.
Thank you so much for your insights.